Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this video, I want to talk about Senseonics, and a recent article came out comparing its growth or possible growth to Tesla. You're going to want to watch this video. So I've been talking about this video. If you look here, all the way back in March 2021, I've been constantly talking about this company, how I feel they're transitioning. They didn't have as much hype back then. And I guess I was at a bowling alley because I had a bowling shirt. But in March, they dropped below $2. $1.82 was the low, spiked up a little bit, then went all the way down to $1.75. So it went back down, bounced twice, and just been on an uptrend ever since. And it's back here at $3.90. So this is a stock. I never really cared much about the technical analysis. When I got in here at this point, I was confident about the company. I liked everything about it, and I wanted to hold for the long term. So I wasn't worried about the ups and downs that come with these stocks. If it dropped, it's an opportunity to reevaluate and maybe consider buying more shares if you're bullish on it. It's extremely important. That's why they always say, do your own due diligence. If you don't do your own due diligence, if you don't do your own research, if you don't have your own confidence, then when you have these ups and downs, you're not going to be able to hold because you don't have the conviction that the person making the video about has the conviction. So it's important for you to have the conviction. I have the conviction because I look at Dexicom, and they are all around an extremely successful company. If you look at their revenue, if you look at their growth, if you look at their financials, they are just an overall absolute wonderful company. They had like a big spike here, 425, dropped all the way down to 322. That's 100 points. Great opportunity to buy if you were bullish. But look at this major uptrend all the way up to 648, now dropping to 619. So if you look down here, they do have a much smaller amount of shares circulating. So they have 96 million. So they've diluted shares a few times, 83 million, 86. So they've been diluting some shares, I'm sure, to raise money, but they may be this is quite high. It may be a little overvalued right now. I've never done a DCF on this company, but it has the ability to get this high because of the amount of shares outstanding, of the amount of shares circulating. There's 96 million. If you look at Senseonics, how many shares they have circulating, they have 392 million shares. So a lot more shares, same thing. Now, in 2016, they started off with 89 million. And they diluted, which is, for an investor, a value investor, you never want to see that, honestly. You never want to see a company dilute this many shares. But I would make the exception for Senseonics because I feel like they're diluting shares, but they're using that money for their projects. If you just read everything about it, everything they're doing to things to put themselves in position to be in the continuous glucose monitoring sector for quite a long time. Their partnerships, their device, it's just everything about them I like. So the last video I made about this, I was kind of like hinting towards how they're kind of breaking out of that meme stock, penny stock. They were heavily shorted, and the short percentage has gone down. But I feel like every time you turn around, there's another article talking about Senseonics. So this article came out with just a few days ago, October 29th, talking about 7 penny stocks with potential to 10x in 2022. And of course, no other than Senseonics is there, and they talk about the FDA approval coming for the 180 days. And the company was affected by the pandemic. And yeah, that is absolutely true. They are definitely vulnerable to COVID because their device has to be inserted by a mid-level providers. They are vulnerable to COVID as opposed to Dexicom. They just kind of mail it to your house. So that's something to look out for. Then another article that got me pretty excited here. So they talk about the ongoing innovation revolutions in both tech and healthcare centers. And they say here which stocks might be the next Tesla from growth standpoint. And they have none other than Senseonics. So they hear another article. This is on October 31st, and they talk about Senseonics could both be gearing up for a monstrous run higher soon. In fact, these low-priced healthcare stocks have a decent shot of generating 1,000+ returns for shareholders in the next 2 or 3 years. And it's pretty much what I've been talking about with Senseonics. Let me see what they talk about. So Senseonics stock is worth a look by ultra-aggressive investors due to its implantable continuous glucose monitoring device franchise known as SENS. So this is, again, we've done several articles about this. Senseonics has only captured a small sliver of this multi-billion-dollar medical device. Absolutely. So in my last video, I talked about how Dexcom is dominating Abbott, and also Medtronic has a small piece. And I just truly believe that they are going to come in and take more market share cap than they have before. You know, there's always the debate of the growth investor versus the value investor. You know, they both have their criticism. They both have their strong points. I like to mix up my portfolio. These are one of those stocks where I think it's getting to both, where it's maybe it's a little expensive right now. I was more confident. You know, I like getting in at 2. It's up 100% since then. But I really think that even if it has some ups and downs, if they start to taper, this is going to be affected. So even with that, I mean, even if you got in now, if you're willing to hold for the next few years, when they get to that 365, then you really don't have to worry about the ups and downs. I just think that they're going to break out. You know, I think they're going to continue to climb. I in no way think that they're going to ever get to $600 a share like Dexcom. There's just too many shares. If they got bigger, though, and they started to get a hold of their free cash flow, started to have a lot more free cash flow, started buying back shares, and started growing and taking more market cap share, then they have a lot more potential. But they're definitely a long way from that, for sure. This is early. You can buy a few thousand shares now and it can drop $1. That's very possible. You have to have conviction. If you truly love the business, the technology, you love the management, you love the steps that they're taking to get to their goals, their partnerships with Essentia, and you really just are so convinced that when their 180-day sensor comes out, that it's going to be exciting for diabetics and they're going to want to switch to the 180-day, even if they're using Dexcom. And then once they're there, I mean, like, they're going to be long-term customers if they know that pretty soon after that, the 365 is going to come out. So for those reasons, I'm extremely bullish. I love seeing these articles come out every other day about how this penny stock is going to 10x, 1000x. This penny stock is worth watching. There's so many people now putting eyes on this. And this wasn't the case when I made the video in March when I had that bowling shirt. It wasn't as popular. So it's great to see so many other people seeing the same thing. I'm not saying I was the first one, but I mean, it wasn't as popular. I see a lot of potential, and don't get me wrong. I mean, if they do not get FDA approval, if anything misses, I mean, this thing is going to tank big time. So I understand that. I understand that risk, but I'm willing to take that risk. So that was my video. Thank you for watching. See you on the next video. Don't forget to subscribe, comment, and like. Thank you for watching.